What I'm going to talk about now is something on every investor's lips. Why buy now? Okay, why would we, take the opportunity to buy in 2022, with conversations about inflation, with interest rates increasing, with Russia and Ukraine? Well, for me personally, Anna and I, we bought the majority of our properties in our portfolio when we were really putting the pedal to the metal, when I was still working a pay-as-you-go job, in and through the GFC period. Tremendous period of uncertainty. Why would you buy property? You're crazy. Well, this is some of the strongest opportunities to prepare and position ourselves for the next bull or strong upswing. And the whole macro idea of you shouldn't be buying now because of what's going on is not applicable. We are very, very targeted with the locations, and we are very good at finding the particular set of circumstances to deliver markets or deliver growth. In COVID, before COVID, when Sydney and Melbourne were going backwards, we were still consistently going up because we've got those same entry conditions that get repeated across the country. So overall, what are we seeing? What are the reasons to buy now? As a mum and dad investor, why would we buy now? Well, we are seeing a confluence of factors, and it's creating very unique market conditions and extreme opportunity. And I'm going to talk to you in a moment about why that is important to you and why it's, potentially sophisticated, high net worth, family office type investors are seeing this as an opportunity. Okay, and this is happening right now. And I'm not just saying this, I'll show you the case study in a moment of a particular high net worth investor to show you how the rubber is meeting the road. What are high net worth sophisticated investors doing right now to take advantage of what opportunities are in the market? So we're seeing strong top-down demand. We're seeing diversifying investors, people coming out of stocks, crypto, coming into property as a safe haven asset. We are seeing sophisticated investors and high net worth investors loading up, more active in the investment class or area segment of the market. We are seeing bottom-up demand, rents increasing, population shifting across Oz, the extreme shortages in the rental market translating to the buy side in key markets. So you've now got two extra buying groups that are very active. Okay, people going from rent to buy and sophisticated investors coming into those same higher yielding, higher income, higher renting markets. Now from the sides, we're seeing the squeeze continue. We are seeing limited alternatives. Incomes and returns in shares, crypto it's just poor performance. People chasing returns are shifting into housing assets, and we have limited supply on the horizon. The building industry is in a shambles. This is all squeezing to create opportunity for the right types of properties. We are seeing established properties with good, strong rental increases, very tight rental markets, buy to rent, and scarcity-driven locations with limited land supply and very strong core drivers of utility. This is the reason. There's a very strong and compelling reason to be buying now, to be loading up before the environment changes. Because what's going to happen in 2023? Obviously, no crystal ball, but I've seen the patterns. I've been a student of what's gone on in Australia for a long time, and I've also been an investor now for almost 20 years. I've seen these patterns, I've seen the psyche repeats. I feel in 2023 we're going to see the dust settle, inflation brought into check, but this is going to be at a cost to the economy. Okay? That's not a big statement. That's all very logic-based, reasoning-based statement. We're going to start seeing supply chains catch up. Okay, which is going to ease the pressure on inflation, the supply side pressure on inflation. But there is going to be a cost for the increases in interest rates and the inflation, and the economy has already started to show signs of slowing down. So potentially we are in line for a recession in 2023. This would put pressure on interest rates to be brought down. Now, one thing that has been a pattern in Australia over many years is interest rates are brought up slowly to see if it's working. They don't want to overcompensate. Interest rates are brought up slowly, and then the moment they get the result that they are looking for, they drop like through the floor once again very quickly over the period of 1 or 2 months or slightly longer. So you see ramping of interest rates and then them dropping back to almost pre-existing levels very quickly. Expect that to occur again, I would suggest, heading into middle of next year. government stimulates the economy at the same time, and they did this through COVID. They generally stimulate the economy through and via property. You know, first-time buyer grants, building grants, changes in tax calculations, etc. They stimulate the economy through property. And they've got a very strong record of doing that. So expect heading into mid-2023, if not before, interest rate reductions or at least slowing down, and then the government getting the economy moving again, and particularly the building industry, and which will take a few years to get back into normal flow through property. What's that going to do to property? And you know, we've seen 2021 as a case study, because we with these factors occurring in this order, potentially are in for inflationary pressure back on property in 2023. Now, the media goes in cycles. You know, I used to be the owner of Australian Property Investor magazine. I understand how this works. The positive news cycle has just begun. Okay, this was an article a couple of days ago. When was it? 29th of November on news.com. Properties could rise as much as 12% if interest rates start to slow down. How do people read that? Property prices to rise 12%, full stop. That media cycle has already started, even heading into Christmas. So people are going to be positioned, they are looking for reasons to get back into property, because traditionally for them, they don't want to fall behind the eight ball, they don't want to fall behind their peers, they want to embrace, you've got feed greed and ambition and all these things driving people to embrace property and get back into it. We're not saying we're greedy or fearful or ambitious. We're just saying we are trying to protect our financial security and build a nest egg for ourselves. That is the masses. They are delivering us to growth. Sophisticated, high net worth individuals are positioning themselves before these guys right now. This is a really interesting case study. So this occurred last week. So last full week going into December 2022. This particular individual, legend from Sydney, $10.9 million in his portfolio in value, 51% LVR, $3,895 a week across over a $10 million asset base. Okay, he's like, what do I do? I've got these wonderful assets. They have done well for me in the past. I have all my eggs in the Sydney market, and the yield is absolutely killing me, right? The return I'm getting is, very, very low. That was his issue. How does he recalibrate his portfolio, and how does he load up on properties now and positioning himself before 2023? So what did we do with this individual? The first step is he sold down 2 of the lower income producing assets. Now, we're not generally advocates of selling if you hold an asset and it's providing a return, a positive return, that's capital growth and yield combined. We keep it, right? But this particular individual, he had sold down he had developed the 2 properties, he'd had a block split, he'd built the 2 properties, he was taking profits. There were some personal reasons why he wanted to do that. But he sold down $2.4 million worth of property. You could just as easily refinance. You could have had $2.4 million in borrowing capacity in terms of accessing the equity in your home as a deposit. So this is a common scenario for investors generally, not just this high net worth individual. He actually sold down $2.4 million worth of lower performing assets. You don't need to do that. It's the same case study whether you did it or you didn't. But what did he do? With that $2.4 million sold to, they were generating, and I've got the data here, those $2.4 million properties total were incurring $24,000 a year in land tax, both in New South Wales. They were low yielding properties, only generating $870 a week for that $2.4 million in value. So with the proceeds of those sales, we were briefed to buy 5 or 6 high performance growth, high cash flow properties. The high cash flow can't be the expense of growth. First and foremost, we are always growth. But we can get very fussy when we look across the whole country to find those rent-to-buy locations with very healthy rental markets, high yields. We purchased 6 properties for this gentleman in 1 week. This was last week. These 6 properties were purchased for $2.385 million, almost what he sold down. The total rental income for these properties was $2,800 a week. The under market value result across these 6 dwellings, we did some great negotiations. We did some very, very good due diligence and leverage with these agents. And when we looked across the country, we got some great deals. The total under market value result from this was 128K. And now this 128,000 goes a long way in paying the selling costs for his two sell downs and the buying costs for these 6 acquisitions. Okay. Now these 6 properties on purchase had a 6.1% yield, right? That's over 100K a year in rental income from these 6 acquisitions. Now, what did that mean to this client? He's now got an extra. This is an extra. So remember before he had $870 a week, now he's got $2,800 a week in rent from the same asset allocation, the same $2.4 million worth of property. He has an extra $100,360 a year in rent in his pocket. And he's now not paying land tax because we've redistributed out across the country. He's saving $24,000 a year in land tax. These properties have a higher growth profile for years 0 through 3, the period of overperformance. So we have now positioned him into very high capital growth locations in the short, not at the expense of long term, but these were Sydney-based investments, so long term they're probably going to go pretty well, his previous properties. In the short to medium term though, we have positioned him into very high capital growth assets. Now the next step for this gentleman, he's now has the serviceability, has the equity production to now go into commercial acquisition. We're just about to launch into the acquisition of a $5 million commercial premises for this gentleman. This goes to show you how high net worth individuals are taking advantage of the current environment. They are really looking for a particular type of property which is high growth, high yield together. We call them lipstick properties, okay? And I won't go into the reasons why, but there is tremendous opportunity for them. You can see how high net worth individuals can take advantage of that opportunity. You can see how investors with pre-approvals or with equity in their own homes or with deposits sitting there can take advantage of this opportunity. You don't need to buy 6 in 1 week. You can buy 1 a year. And you are still applying the same high net worth principles to your own portfolio, to your own asset accumulation.